Hi, everyone. I'm going to talk about Chapter 1, Introduction to Corporate Finance. So for this chapter, there are certain learning objectives we want to go over. So the first one is about what is corporate finance and the role of the financial manager. Then we're going to go through some of the forms of the business organizations. There are three main forms of organizations. So basically, sole proprietorship and partnership and corporation. And then we talk about what's the goal of the financial management. And then we are going to introduce about the agency problems and how the corporations can deal with that agency problem. We are going to learn about financial markets, okay, and financial institutions. And we're going to finish with a brief discussion about the trends in the financial market and the financial management. Okay, so there are three main questions would be asked. So around corporate finance. So the first question would be, what long-term investment should the firm take on? Okay, so for a company, for a business organization, okay, they has to consider that what would be their long-term investment. Okay, are they going to building? Are they going to building a warehouse? If they are anticipate that they're going to need a lot of inventory because the sales increased. They want to make sure that they have enough inventory on hand, right? Should they invest on trucks because the supply chain is a concern? So the company should really have their own probably truck teams, right? So that they can just run their own trucks. So those are the questions, right? So the firm, okay, what are the long-term investment project they should consider? And then if you have identified certain projects, certain investment that to go with, how can you secure the fundings? You need money for that, right? You want to build a warehouse, you want to buy trucks, where those money come from, right? So where can you get this long-term financing? Okay, so that would be the second question. Okay, and the last one would be just a day-to-day operation, right? So not long-term, but even for the daily activities, right? Can the company manage the day-to-day financial activities of the firm? Okay, do they have enough cash on hand to pay for the salaries of their employees, right? I'm pretty sure that it won't take very long. You can delay the payment of the salary very long to the employees, right? Most people nowadays, they live from check to check, right? If you don't have cash, you don't have the money to pay the salaries, you'll be in big trouble, right? So this is another one. So the three main questions. The first one would be, what would be a long-term investment the firm should consider? Second, once they identify the long-term investment, where the money comes from. And the last one is about the day-to-day operation. Do you have enough resources, financial resources on hand to make sure the company operates well? Okay, so when we ask these kind of questions, who are the persons are responsible to answer these questions? So to solve these questions, to take care of these questions, whose duties are these? So we say this is the duties, responsibilities of the financial managers of the corporation. So there are different roles, okay, different roles. At a lower level, you would have a title job position called a treasurer, okay? So the treasurer apparently is dealing with cash, okay? So the main job duties of the treasurer would be cash management. So maybe you want to collect cash, deposit cash to the bank. Capital expenditures, right? you needed to have large item purchase. Maybe you buy a building, right? Those are the capital expenditures. And the financial planning, right? You want to kind of have a budget, have a plan to make sure that every month there are enough cash available to ensure that the business operates well, right? On the other side, you have a controller, okay? The controller would be the person that take care of the books, right? So financial accounting to record the journal entries, right? To record the different transactions, business activities, right? And cost accounting, right? For companies who are manufacturing items, if they are making like a furniture, if they are producing foods, right? They want to make sure they understand their cost, right? Because they have to know their cost numbers in order for them to run the business, right? So, and then you probably have learned this, right? So that's related to cost accounting, right? Kind of the job of a management accountant, right? And the taxes, right? So the company has to pay employees payroll tax. They have to pay the corporate tax. Maybe they have to file GST, right? All these taxes charges by the government of different levels. So and the data processing, right? They probably will issue T4s to the employees at the end of the year, right? So that employees can file their T1 income tax return. So you can see, I would say mostly the treasurer is dealing with the cash, right? And the controller is dealing with the book, right? Dealing with the book. So both need to report to somebody called Chief Financial Officer. In short, we say this is CFO, okay? Chief Financial Officer, okay? And then just a joke here. What about university financial officer? Okay, so university financial officer, in short, is called UFO. Okay, UFO. You all know what is UFO, right? Financial management decisions. Okay, so when you ask the first question, what long-term investment should the firm take on? So that would be a plan, right? That would be a budget. That would be a thinking ahead of time. So this is the capital budgeting, okay? And the second question would be, where will we get the long-term financing to pay for the investment? Should we go borrow money from the bank, right? So basically, you can tap into the pocket of the creditor, right? So, or should I maybe issue shares, right? I should just issue the stocks, shares to the public, right? So you could either borrow the money from the creditors, from the bank, right? The bond issuers, or you could get capitals from the capital market, from the investors, right? In the form of shares, right? So that's the two ways, right? So should you do debt or equity, right? So basically that's the concept, debt or equity. So this would be called capital structure, right? Capital structure will tell us, is this company relying on more on debt or more on equity? Okay, so last question, how will we manage the everyday financial activities of the firm? So this is called working capital management, okay? Working capital management. What is working capital? Working capital is the difference of current asset and the current liability, okay? So you can see that, right? When you run a business, you need a current asset, right? So you need to have cash, inventory. Maybe you need to have you would have accounts receivable because your customers is not paying you quickly enough, right? At the same time, you probably owe the suppliers money, right? Those are the current liabilities. So the difference, current asset minus current liability, the difference, that's called working capital, right? So you want to make sure that you have a positive working capital. So you have sufficient current asset to cover your current liability, right? So, okay, so that will be the capital budgeting, capital structure, working capital management. Okay, now let's switch the gear to talk about the forms of business organization. There are three major forms in Canada. First one is called the sole proprietorship. So this is one person show, right? You can see a lot of the tradesmen, right? Like a carpenter, like a carpenter, like a renovators, painter, right? Builders, right? So yeah, these people they just do the business by himself, right? So what and then you also have a partnership. A partnership would be for a lot of the professionals like accounting, right? MNP is one of the accounting firms in Canada. So lots of the CPA, the professional accountants, right? They work together. They formed this organization, right? This is called a partnership, okay? And depending on the liability, it could be a general partner or versus a limited liability partner. Some other professions like lawyers, right? They also adopt partnership. So in Canada, the Borden Ladner Gervis, right? The BLG, this is a law firm, right? This is also a partnership. Sometimes the doctors, right? Several doctors, they also work together to form a partnership. And the next one would be a corporation, right? A corporation, probably this is nothing new to you. For example, public companies, right? Like Petro-Canada, the stocks are exchanged in the stock exchange market, right? This is a public company. So there's a lot of shareholders, right? If you are investing, you probably have shares of these public companies. So you are the owners, right? Even though maybe only own a very small percentage of the corporation, but you are essentially the shareholder owners of the corporation. Okay. It could be also private corporation. So not all the corporations are big or large, right? It could be a very small private corporation. So this is my accounting professional corporation. So I have a part-time accounting practice, right? So I set this up as a corporation, not through myself. Okay, I could just use this as a sole proprietorship, but I think it's much better when I set it up as a professional corporation. Okay, so my corporation is a private corporation. Petro-Canada is a public corporation. Okay. Let's go through them one by one. So for sole proprietorship, this is a business owned by a single individual. So the word sole, right? The advantage is it's very easy to start, right? It's least regulated, okay? You make the money, it's all your money. And when you are reporting the tax, basically, this would be considered as a business income, okay, in your T1 return. Okay, so you may work for a different person, right? For a different company, you receive the T4 slip. So that's your employment income, right? But because this is the business you are doing, okay, any profit you earned from this business, that's considered as a business income. So you just report it in the same T1 return, okay? So anybody can do that, right? Anybody can do that. The disadvantage is the unlimited liability. Unlimited liability. So for example, let's say if you decide to sell food, okay? If you sell food to people under your name, okay, the business is a sole proprietorship, right? So you have unlimited liability for your activities. So let's say you sell the food to the customer, they ate it and they felt sick and they die, okay? And then the family sue you for $10 million and you lost the lawsuit. So what is gonna happen? So they're gonna take away everything you have until they reach that $10 million, okay? So basically you will lose everything, your house, your car, your clothes, your furniture. So basically unlimited liability. So that's why, sometimes, you have to make a judgment, right? When you do a business, is that activity is very risky, right? How likely you may be sued by a customer, right? You want to make sure that you protect your own assets, okay? And the business is also limited to the life of owner, right? Because this is your business under your name. And when this person is passed away, that business is basically it's ended, right? Equity capital limited owner's personal wealth. Okay, so how much equity you can have, you can start with. Basically, it's very limited, right? How much money do you have in the bank? That's your equity you can start with, right? So let's say I'm a sole proprietorship. I want to do an Airbnb hosting business, right? A combination business. And I only have, let's say, $400,000 in the bank, right? To do this business, I probably can only do like one house in Vancouver, right? So if I use the $400,000 and get some loan from the bank, right? Together, maybe let's say I get $800,000, I maybe only can purchase an apartment in Vancouver, right? So so that you can see that my operation is quite limited just because my equity is very limited, right? If you consider a public company, right, they have access to the equities of the stock market, right? So that's why they can run lots of run the business on a larger scale, right? Difficult to sell the ownership interest, right? So if the business is tied to you, tied to your service, your skills, right? If you decide to exit from business, who's going to buy from you, right? Because you are the person that is important to that business, right? So it's hard to sell that business. Partnership. So partnership, the advantage is that you may have two or more owners, right? The reason why this is an advantage is because when you have more owners, you can actually have more human and financial capital available, right? So for example, I'm a CPA, right? I can have my own practice, but in the summertime, I want to take a vacation, right? And then my client may not take a vacation. It may be my client's busiest time of the year, right? Who's going to cover me? Nobody can cover me. I'm on my own, right? So that's why this partnership is important, right? If you have different partners, different CPAs working together, even if I'm taking time off, right? My partner can cover my absence, right? If there's emergencies from my clients can call the office, and the office will direct the phone line to my partner who is available to help, right? And also, it's very expensive for one person to rent an office building in downtown Vancouver, right? It's very expensive for one person to bear that level of the cost, right? But if you have 10 partners, right, they run the building and they share the office, right? So right away you can see that they kind of have more financial capital, right? They pool the financial capital to share the cost, right? So this is all the advantage, right? Forming a partnership. And it's not hard to start, right? It's not hard to start if you have people, right, in the same profession, they're professionals. They sit down, they decide to work together, right? They form basically a partnership agreement. They can start a partnership. And a partnership on its own is not a legal entity. So basically that means for tax purpose, you do not report tax for a partnership. So what happened is you have to allocate the partnership income among all the partners, and the partners will report that income in their personal tax returns. Disadvantage, right? Disadvantage, depending on the partner's role, some partners are exposed to unlimited liability. Other partners may only exposed to limited liabilities. Okay, so in this sense, that the limited partner, right, the partner with limited liabilities, they are in a better situation, right? Because if they screwed up something with their service, they were sued. Well, what can they lost, right? The maximum they can lose is all their investment into the partnership, right? The people will not go after their personal asset, personal belongings. Okay, and the partnership will dissolve when one partner died or wish to sell. Okay, so if one partner passed away suddenly, the partnership dissolves. Okay, or if they want to, one partner wants to sell, that partnership dissolves. Okay, it's also difficult to transfer the ownership. It's also difficult to transfer the ownership. Another big disadvantage is that when you have more people, so it's nice, we cover for each other, we share the cost, but sometimes it's hard to work with other people, right? People may don't agree with each other, and they all have their own thoughts. Sometimes when you run a business, this can be a very big challenge, right? I have seen, when I used to work for the accounting firm, I have seen partners they don't agree with each other, and eventually some partners was so upset they just left the business. Okay, and the corporation is a business created as a distinct legal entity owned by one or more individuals or entities. Okay, so corporation on itself is a legal entity. Okay, so for example, Tesla, right? Tesla, the business, right? It's a legal entity. Okay, Musk is an individual. He is probably the largest shareholder of Tesla, right? But these two are separate. We don't want to mix them together. Okay, so you have Tesla. Okay, so that's a corporation. That's a business. If a car caught on fire, if a driver, if a passenger died in the autopilot car, they decide to sue, they will sue Tesla, right? They will not sue Musk, because the Tesla on its own is a legal entity. Okay, that means the corporation, they will file tax returns. That's the T2 tax returns. So for individual, you have T1. For corporation, that's the T2. Okay. What's the advantage? Limited liability. Okay. So what does that mean is that if I am the boss of a corporation, I have, let's say, $10 million. I invested $1 million to the corporation. Okay. So I still have $9 million under my own name. Okay. So if I lose the corporation, I lose that $1 million. I still have the $9 million protected. Okay, so this limited liability. Unlimited life, right? If you think about, some of the corporations has been around for 100 years, right? Even the original owner, the founder, passed away, they are still able to pass this transferred ownership to the second generation, or they can just sell it to another person, right? So basically, the management and ownership are separate. Okay, so Musk, okay, I will use a different example. Okay, and it's a funny example because Steve Jobs, right? He started Apple, right? But did you know that he was once fired by Apple? Isn't that funny? So this is the business you started. Okay, you are running it as a CEO. Okay, and then he was fired by the board of Apple, right? So this is what we are talking about. The ownership and the management are separated. Okay, so who are the owners of Apple, right? The owners are all over the world, right? The people whoever holds Apple's stock, right? And those people will elected directors to from the board of directors, right? And then who is the worker? Who is the manager of this business? Well, the CEO, right? The CEO is the manager of this business. Okay, so CEO is the management, and the ownership is on the shareholders. They are two different people, two different groups of people, right? So therefore, it can happen, right? Steve Jobs, he is the he probably is one of the largest owner, right? He owns probably the largest percentage-wise ownership, but on himself compared to the rest of the board is still a relatively small portion. So for example, I think for Microsoft, probably Bill Gates owns only 11%, right? So compared to the other 90% is owned by other people, right? So then the majority decide to fire Steve Jobs, okay? And he loves his job. Isn't that funny? So the separation of the ownership and the management, right? If you think about the sole proprietorship and the partnership, right? You are the boss, nobody can fire you, right? Nobody can fire you. Like I said, the transfer ownership is easy. So let's say I own 100% of my own company, and then I can sell it to somebody else. I can just sell the shares to somebody else. Easier to raise capital, right? So if you raise capital, just issue shares, right? Issue shares, and you can raise the capital. Disadvantage is also a separation of ownership and management. Why? Because you never know if that manager is really working for the best interest of the shareholders, right? So I'm not in the business on a daily basis, right? I don't know what is going on with the business and who has the best knowledge and the information, the CEO, right? But are you sure that the CEO is really try his best to serve your best interest, right? Double taxation, okay? So basically the income will be first taxed at the corporate level. And then when the after-tax profit is distributed to the shareholders in the form of dividends, the shareholders will be taxed again for the dividend income. Okay, so two levels of taxation. First, the profit will be taxed at the corporation level, and after that will be taxed at the individual level. In Canada, the taxation is really trying to work through a process called integration. That means they are striving to reach the goal that no matter how you earn this profit, whether through personal or through corporate, ultimately the total amount of tax you pay is the same, okay? This is in the ideal situation, but integration is very complicated. It could be happened, let's say in some provinces that it could be a double taxation, means that if you earn income through corporations, ultimately you are paying more tax than if you would just earned it through your own sole proprietorship, okay? So that will be something you would learn in the taxation courses, right? I will not talk too much about it here. So that's the three main forms of organization. And another type is not very common, it's called trust, okay? So what is the trust? Trust, again, trust is not trust is somebody have some properties, okay? They would want to form a trust, okay? So they want appoint a trustee to hold this property, okay, for the beneficiary, right? So if, let's say, grandpa, right, he really wants to his grandchildren to go to university, maybe he would say, he would probably set up a trust, okay? And he give up this asset, let's say a property, a house, and then he would appoint a trustee, could be himself or somebody else, to take care of that property. So basically, he transferred that ownership from under his name, he gave it up to the trust, okay? And now who owns that property? The trust owns that property, okay? And then the trustee is holding the trust, manage the trust. So there's income generated by the property, and depending on how the trust is drafted, trust deed is drafted, so the trustee will allocate the income accordingly to the beneficiaries, right? So he would, for example, he would wait until the grandchildren reached 18 years old, go to university, and that's the time, according to the trust deed and the will of the grandfather, he's gonna allocate the income to that grandchildren so that they can finish their university. Okay, so trust is very interesting. Trust is a separation of the ownership, okay, the ownership and the enjoyment of the ownership and the benefit. Okay, so the trust is a form of the separation of the ownership and the benefit. So normally, if I own something, okay, I would enjoy the benefit. So if I own a Lamborghini and I'm the one who is gonna really drive it, right, on the highway, make myself looks really cool, right? So I owned it, I enjoy the benefit. But for trust, it will be like the ownership, okay, is there, and the benefit is you don't have the benefit. So if I gave up I owned that property and I gave that property up to the trust, right? So the ownership is with the trust, but the benefit is on the beneficiary, okay? So in this case, the income trust would be holding this debt and equities of underlying business, but the income they generated will go to the unit holders, right? So for investors, sometimes they would buy mutual fund, right? Okay, and they would receive a T3 tax slip, right, to report. So what happened is, many investors, they pull the money, right? They purchase that investment, right? And that who owns that investment? And the trust owns that investment. Who are the beneficiaries? These unit holders. So therefore, the management companies will run that business, and when they earn the income, they distribute the income to each unit holders, right? Depending on the shares of they have. Okay, so that's the income trust. Cooperative. This is also a very interesting organization. It's a corporation, but it's not a typical corporation. Okay, so basically, normally what happened is it's for the benefit of a community. The setup of this kind of corporation, cooperative, it's for the benefit of a community to serve a common purpose. And it's owned equally by its members, okay, by its members. And for example, the Central Alberta Cooperative, okay. So on the under the week 1, so I have put a link to a website of this cooperative. You can just give a read. It's an interesting corporation, right? The setup, right? How they allocate the benefit is quite different. Okay, so normally they will, if there is a benefit, they make some actual profit, they can reinvest the profit back to the organization, or they will distribute the benefit to the members, right? But the members are also at the same time are also the customers of the organization, right? So and how they gonna allocate that profit? They could just allocate it based on how much they use the service. Okay, so anyways, I want to encourage you to read about this Central Alberta Corp stations, so locations. I think you buy things from there. I think it's a retailer or something. Yeah, so just give a read to see how this organization is structured. The goal of financial management. Okay, so what is the goal of the financial statement? Well, maximize profit, right? Try to make as much money as possible. Minimize cost, right? Keep the cost down. Maximize the market share, right? You are hoping to maximize the proportion of your business in the market. Maximize the current value of the company's stock, right? You want to increase the company's stock price. Okay, so does this mean we should do anything and everything to maximize the owner's wealth? Okay, so basically, some of the goals are not, they are kind of on the same direction, right? So you think about if I want to maximize the wealth of the shareholder, right? How can you do that? Well, if you maximize the firm's value, then the stock price will go up. And then the shareholders' wealth will go up, right? Because the shareholders are holding so many numbers of shares. If the share price go up, and the shareholders' wealth will go up. So how can you maximize the firm's value? Well, you can maximize the profit, or you can minimize the cost, right? This is all the ways to, right, try to increase the firm value. So you can see these goals, they do not, they are actually the same, right? They are equivalent. They are equivalent goals. Now let's talk about the agency problem and the control of the corporation. Okay, what is called the agency relationship? Okay, so usually the principal, they will hire an agent to represent their interest. It could be, I'm looking for a house, but I don't know too much about the real estate market. So I'm the principal, I'm going to hire a real estate agent to take me to shop around to find the house, right? So all, you don't know anything about income tax, right? So you want to hire me, I'm a CPA, I'm a tax specialist. You want to hire me to help you to take care of your T1 returns for 2022, right? So you can see that this agency relationships, right? But then the thing is, okay, ideally, right, the agent will work for you. They will represent your best interest. But is that really true in our real life, right? Think about a real estate agent, right? If you are buying a house, well, the real estate agent will not charge you, right? The real estate agent will make money when there is a deal, right? When the transaction is closed, right? When that transaction completed, right? They probably will share some of the brokerage fee with the seller's agent, right? And the seller will pay for that agency fee, right? Okay, so basically, what's the primary goal of that real estate agent? Well, the real estate agent's primary goal is to make sure there is a deal, to make sure the seller and the buyer make a deal together, right? So, well, to you, what's the best interest? The best interest will be find the house, right, at a reasonable, good price, right? Find a good house at a good price. That's your interest, right? Sometimes the real estate agent may not represent your best interest. So just be careful when you are looking for somebody to work for you, right? So this could be a problem, okay? So the stockholders in the business context, the stockholders is the principal, they hire managers, the CEO, right, to run the business, to run the company. Okay, and the problem is that CEO really working for you? Is the CEO always think the best interest of the business? Okay, probably not, right? Because the CEO has his own interest as well. So agency cost, right? Agency cost. So if an agent is not really working for you, is not really trying his best to achieve the best interest of shareholders, this would be considered as a cost to the business, to the shareholders. Okay, so how the corporation is gonna control this problem, deal with this problem? Well, the first one is they offer the package. So the incentives for these managers will try to land up managers' interest with the corporation's interest. Okay, so for example, nowadays the CEO of big corporations would have some of the certain proportion of the compensation in the form of stock options or tied into stocks price. So for example, a company may have a contract with the CEO saying that at the end of this time, okay, if the stock price is at this level, you are going to receive a bonus, right? See, now it's interesting, right? The CEO now would want to work hard to make sure that the stock price exceed that target level so that he can realize his personal interest, which is tied to the bonus, right? So that's contracting, right? That's the compensation contract nowadays. They try to motivate the managers, right, to work for the best interest of the corporation. So if they link the manager's self-interest, personal interest with the corporation's interest, so that would solve this agency problem, right? Okay. Social responsibilities and ethical investing. Nowadays, investors are more social responsibility aware nowadays. Okay, they are hoping the corporations are not only after profit, after money, they also hoping the corporations are also a good citizen for our human being society, right? So if you think about my own experience, that in the past 20 or 30 years, China has experienced a huge, like a booming, probably 20 years of economic development. Okay, because they play the role of the, as the world factory, right? Everything is very cheap, right? But those comes at a price, right? Because the environment pollution in China, right? So those all part of the cost, right? The capital doesn't consider, right? So when we buy something really cheap in Canada, if it's made in China, we think it's good, right? Because the business is happy because they are keeping the cost under control, right? But behind the scene, there's lots of other important costs, including environmental impact, air pollution, right? Lots of those kind of things. The good thing is in Western countries, people are more and more aware of that importance of a lot of these issues, right? So corporation has to be responsible for the communities where it's operate, for the customers, right? For the employees, and for their environment, even human rights, right? So it's kind of interesting now, like for example, AMW, right? AMW, they advertising their product, their beef as the best quality, right? So they are responsible for their customers' health, right? It's interesting, even for the fast food restaurant, right? They would label the amount of calories of the food, right? It probably doesn't help, right? If you love McDonald's, you saw that, oh, that sausage egg muffin is gonna be like 500 calories. I probably should not eat it. It's too much energy, right? No, people will still eat it. But at least, right, now they transfer the responsibilities to the customer, right? They make you aware of the nature of the food, right? The amount of calorie, and you still want to buy it. That's your job, right? But the corporation, they are under the political pressure. They have to make sure that they're responsible for their customers, right? Um, yeah, certain business, I don't know. Yeah, I think some business are really promoting human beings' well-being. Other business, not so much. Okay. So for example, certain business, like addiction business, right? Addiction. I don't think it's those gaming companies, right? Gaming companies is good, right? It's good that they create all these games that we can enjoy. It's really fun, right? But at the same time, it created a big social problems, right? Lots of young kids, they out of control, right? They cannot control themselves. They overspend their time on the games, right? And of their best time of their life, right? So yeah, so this kind of things, the corporation, right? You have to have a corporate image that, right? So be responsible, right? Be a good citizen in the human being society, right? Controversial business activities including alcohol, gaming, genetic engineering. This is horrible. This genetic engineering. I heard a Chinese scientist. He edited one of the twins' genes. That's horrible. I don't know how that will affect that baby's life in the future, right? Because this is in the early development, right? The scientist decided to add the gene, added the genes of one of the twins. Horrible. Yeah. Nuclear power, pornography, tobacco, weapons, right? This kind of business. Yeah. Okay. Cash flows between firms and the financial market. So the left side, the reddish box, this representing the company, the organization, the firm. Okay, and they have assets, right? To the right side, they have these investors in the financial market, right? So for example, in Canada, we have the Toronto Exchange, right? Toronto Stock Exchange market, right? So there are a lot of investors in the market. So first, the cash flow will flow from the financial market to the companies. The reason for that is the firms will issue stocks, and the investors will buy. They pay the money, right? So therefore, the cash goes from the financial stock market to the companies, to the firms, and the firms will use this cash, right, for investment. As a result of the investment, they are going to make money, right? After they make money, they have the actual cash. What are they going to do, right? First, they need to pay tax. They have to give some money to the government, right? And sometimes they have further projects. They need more cash to invest. So they're going to reinvest the money back to the business, right? And other times, they could pay back the creditor. They pay the interest to the creditor, and they pay dividend to the investors in the financial market. Okay, so this would be a picture like this. So the arrows representing where the cash goes from the firm, right? So when the firm spend the cash, they pay the government. Those are the tax, or they put the money back to the corporation. They reinvest the money, or they will pay to the creditor, to the bank, in the form of interest expense. In the form pay back to the shareholder in the form of dividend. Okay, so that's how the cash flows. Financial institutions, In Canada, RBC is the largest, Royal Bank of Canada, and then you have BMO, you have TD Bank, CIBC, and the Scotia Bank. This is the 5 largest banks in Canada. In fact, I think I have used all of them. Okay, I have used all of them. What are these financial institutions? They act as intermediaries between suppliers and the use of the fund. Okay, so I have actual money. I put my money into my deposit into my bank. Somebody need money, they need to borrow money from the bank, right? So where the money is sitting in the financial institution. That's the intermediaries. How do they make money? Well, they make money by on the spread of the interest. Okay, so they pay less interest on the deposit from the customer. They charge higher interest on the loans they issued to the borrower, right? So you see, when people supply the money, they pay them lower interest rate. When people demand money, they charge them higher interest rate. So there's this interest rate spread. That's where they make the profit. So this is the indirect finance. Direct finance will be service fees, right? They will charge you like certain fixed amount of money every month, right? $10, $5, right? And sometimes you go there, you said, well, I need to get a money order or bank draft. They will charge you like $7, right? Something like that. So there are service fees, right? That's when you are dealing with the bank, there are service fees. Those are the direct finance, okay? Trends in the financial market and the management. Financial engineering, so this would be because of the financial world is getting more complicated. So the financial managers has to take the efforts to design new securities, new financial processes to address the constantly changing financial environment. Okay, so when they are designing new product, new securities, this is called financial engineering. Derivatives securities. Derivative securities are useful controlling risk. So what do we mean by this, right? What would be a derivative securities, right? So for example, you could have a forward contract, right? So let's say I know that in my business, I'm gonna need $1 million US in May 2023, right? I'm gonna need $1 million US in May 2023 for my business, but I'm really concerned about the exchange market, right? What if at that time Canadian dollars will be very low compared to US dollars, right? I'm gonna spend a lot of Canadian dollars to buy $1 million US, right? So I'm concerned about that exchange rate, right? So I could enter a forward contract with another party saying, right, I'm going to have a contract with you. I'm going to buy the exchange rate, buy the $1 million in May 2023 at this exchange rate. So it's a locked-in exchange rate. Doesn't matter what's the real exchange rate in May 2023. I want to reduce my risk, so I just want to have a fixed rate, okay? And so I'm transferring the risk from me to who? To the other person, right? Signing the contract. The other person is willing to take that risk, right? So now, so basically, the other person will charge you a foreign exchange rate higher than the current interest rate, current foreign exchange rate, and he's betting on foreign exchange rate will not go up, right? So you can see that for me, right, as a business owner, I probably just want to reduce my risk, right? Controlling the risk. So another example would be what happened recently, right? If you are signing a mortgage contract, if it's floating, right? If it's floating, right, versus a fixed, right, versus a fixed. If it's variable versus fixed, right? So variable means the mortgage borrower is taking the risk. If the interest rate market changing, or the change, the fluctuation, that risk is taken by the mortgage borrower. But if I say I want to fix my mortgage rate, I'm passing that risk of the interest rate change from myself to the bank, right? And of course, your fixed rate it will be higher than the variable rate risk, right? Because the bank has to make some money if they are taking the risk, right? So you can see that now, right, for the variable mortgage borrowers suffering, right? The people who have a fixed mortgage rate, when the rate is low, they are laughing, right? So that was a benefit, but they also caused some big problems. The 2009 financial crisis in the States, starting in the States, is actually caused by derivative securities. Okay, so what happened is so the bank would give these mortgage loans to people who are not with bad credit. Okay, they are called a subprime lender, right? Those people have a bad credit ratings, but the bank was still giving them the mortgage loan, and then the bank will pass the risk of this lender's default to the investors. So they packaged these mortgage loans as asset-backed securities and sell it to the investors. Right? So then what happened is when the housing collapsed, and these homeowners are subprime homeowners, they can't pay it, so they walk away. The housing price is down, and the market, they created a big problem, right? And then the risks is borne by the investors, right? By the insurance companies. So that's a derivative. Okay. Advanced in technologies, e-business, right? So the supply chain management and the additional inventory is a key nowadays, right? Because we can buy things on the internet from different countries. The problem is, how can you get items from A to B, right? We have suffered the supply chain problems during the COVID time, right? When countries are locked down, right? We have nothing, and all the prices are going up. It's really, there's a shortage of chips, and the automobile manufacturers cannot supply the cars, right? So I think even the Toyota dealership called me, asked me if I want to sell my car. Okay, so that's how much the vehicles was in shortage during the COVID time. And that supply chain problem is also going to affect the prices of our food, right? So the inflation is very high. Part of that is due to the supply chain issues. Corporate governance reform. So there was there are certain very well-known scandals happened. So people talk about the corporate governance reform. Basically, people propose that a stronger and a more independent board of directors can prevent management issues. Okay, so that's our chapter 1. So just to summarize, we talked about what's the advantage and disadvantage between a sole proprietorship, a partnership, or corporation. What is the primary goal of the firm to maximize the shareholders' wealth? What an agency relationship and the agency cost are. Agency's relationship would be the shareholders, stockholders hire the managers, the CEOs, to run the business. And the cost is that the manager may not act in the best interest of the corporation. What ethical investing is, basically, people nowadays are more aware of the importance of social responsibility. Okay, so they are hoping that the corporations they are investing into are also a good player for the human being society. They need to be responsible for the well-being of people, for the community, for the employees, right, for the customers, and for the environment, those kind of things. The role of the financial market are supplying fundings, money, right? So this money will be used by the companies, public companies. The role of financial institution served as intermediaries, right? Okay, so that's for chapter 1.